Hello and a warm welcome. You've joined us on All About Your Company right here on ET Now. I'm Ashesha Advaryu, and today on the show we're going to put the spotlight on one company from the auto ancillary sector which has outperformed the Nifty 50. The stock has given 28% returns over the last 1 month, clearly outperforming the Nifty. Yes, we are talking about RailTel. And we will discuss this with the management of the company. The stock, as I mentioned, the stock is surging in trade today. And over the last 1 month, the stock has given phenomenal returns, especially as compared to the Nifty 50 index. But what am I supposed to know from the company? Let's put the spotlight on that first. The company has capacity expansion plans. The company is looking to enter into data center business. It is targeting 20% revenue growth and 11 to 12% EBIT margins in FY27. What makes them confident? That will be the first important question we are looking to get answers to. We will be joined by the management in just a minute. Apart from that, let's also talk about the data center business. As I mentioned, the company sees immense opportunity within that space. The company has also lined up capex for expansion in the data center business. What is the growth opportunity there? We'll talk about that to the management in just a bit. Other than that, within data centers, the company is looking to send nearly 102 edge data centers. What is the capex requirement? What will the timeline of this be? And what will the strategy be? What will the outcome be? Those are some important questions when it comes to edge data centers. Other than that, let's also talk about other revenue growth drivers for the company: cyber security and Aadhaar authentication. What kind of revenue will these segments generate for the company going forward? We will put the spotlight on that as well. Other than that, let's also talk about a couple of other talking points that we will focus on. Company is focusing on low margin projects which consume majority of their cash, and analysts are now doubting and perhaps they are having some questions with respect to working capital requirements of the company, which are now surging. We'll talk about that in just a bit. But first up, let's talk about the company. Now, this, remember, is a Navratna enterprise. It was established way back in 2000. It is a Navratna Central Public Sector Enterprise. It was incorporated on the 26th of September 2000. So that's as far as the brief background of the company is concerned. It is one of the largest neutral telco infra providers in India. It owns pan-India optic fiber network, and its network actually covers 63,000 route kilometers. So that's the kind of range that it operates as. So that's the brief background when it comes to the company. Let's also talk about network infra. As I mentioned, 63,000 plus route kilometers, that's the backbone of the company. It has access network to across 21,000 plus kilometers, and it has high capacity bandwidth as well. So that's the network, and that's the operational bandwidth that the company works with. Let's also talk about major customers, and mainly it's the government bodies, Ministry of Railways, Air Force, Coal India and its subsidiaries, and a couple of other large players, especially from a data center point of view. They have Amazon, Google, Airtel, Vodafone Idea, and a couple of other public sector enterprises like ONGC, HPCL, State Bank of India and Central Bank of India. So these are some of the large customers that RailTel caters to. Let's also talk about the services that it provides to Indian Railways. First is signaling and telecom, the most important arm. Data center is another service that it provides to the Indian Railways and sees immense opportunity within this space to grow going forward. As far as new initiatives are concerned, it is looking to set up 10 megawatt of data center in Noida, 100 plus edge data centers pan-India. That's the major growth trigger for the company going forward. AI-enabled tool, especially for government applications, and it is also focusing on international business. We'll talk about the international business part in just a bit to the management, but these are the 4 initiatives that the company has been working on and looking to expand across over the next few years. Next up, let's talk about the financial trend then. Revenue has consistently grown. We have seen 4-year CAGR for revenue at about 29%. From about 1522 crores of revenue in FY22, it has risen to about 4,300 crores in FY26, implying 29% revenue CAGR over the last few years. Let's also talk about a couple of other metrics then. And first up, EBITDA, which has seen a CAGR of about 15%, because that has also grown from 370 crores in FY22 to about 636 crore in FY26. But margins, they have seen a bit of a contraction over the last few years, and we'll ask the management as to why this has happened. from 24.2% in FY22. Look at the kind of decline that we've seen in margins over the last few years, with margins below that 15% mark in FY26. So what led to that? In fact, management is targeting EBIT margins in the range of 11 to 12%. We'll talk about what led to this decline and what's the outlook on margins for the next few years. As far as profitability is concerned, that has seen a steady uptick. So we'll talk about that as well. Moving on to balance sheet then, equity position continues to remain very strong. We have reserves which have grown because of the cash that has been generating over the last few years. And the book value clearly has risen from 1827 rupees per share to about 2262 at the end of FY26. The company has no borrowings. It is a net debt-free company. And the cash and bank balance has also risen substantially from about 485 crores at the end of FY24 to about 650 crores at the end of FY26. So what will the utilization strategy be? That is also another important question we will try to discuss with the management. Shifting focus on return on capital employed then, that has also seen a steady uptick from about 16% in FY22. It has risen to about 23% in FY26. So clearly, return on capital employed has also seen a steady uptick over the last few years. So that's as far as the balance sheet parameters are concerned. Let's also talk about shareholding pattern then. Roughly 73% is owned by the government, that's the promoter group entity. FII shareholding has risen to 4% at the end of FY26, but on the flip side, we have DIIs who have gone ahead and trimmed their stake to just about 1% as on the 31st of March 2026, and public shareholding has largely remained steady at that 22% mark, and promoters are the Government of India in this case, which hold about 71% stake in the company. Shifting focus to valuations then, 5-year average at about 25 times. This is 1-year forward price to earnings multiple. Currently, it trades at 29 times. So as compared to the 5-year average, it looks slightly expensive. But as compared to the 5-year range of 10 times to 50 times, it is in the middle of that range. So no major complaints when it comes to the valuations that the stock is trading at. So that's as far as valuations are concerned. Shifting focus to analyst recommendations then, and this is not a widely tracked company. 2 analysts track the stock, both of them have a sell rating, and I believe they have a negative rating on this counter, because of which the 12-month potential also implies a downtick on the stock over the next 12 months. So that's as far as analyst recommendation is concerned. Let's also talk about the growth drivers and where the management sees the company going forward. In FY26, company reported revenue growth of 22%, and management is guiding for 20% revenue growth in FY27 with EBIT margin guidance in the range of 11 to 12%. So that's as far as the guidance given by the management is concerned for FY27. Order book stood at about 11,500 crores at the end of April 2026, and about 3 to 3,500 crores of revenue will be recognized in FY27 itself, and management expects that the strong order inflow trend is likely to continue over the next few years. So management commentary on order inflow is on the positive side. Let's also talk about data center business. That is one opportunity that the company sees immense growth in. So we have FY25 data center revenue, which was at about 127 odd crores. It rose to over 200 crores in FY26, and this is only expected to rise going forward because of the capacity expansion plans and the fact that the company is looking to set up more data centers and edge data centers over the next few years. Now, as far as FY27 capex is concerned, management has guided for about 300 crores of capex. Majority of it is, as I mentioned, earmarked for data centers and telecom expansion, and edge data center expansion is likely to accelerate in FY27. The company has already set up edge data centers in quite a few cities of India, and it is looking to expand that further. So that's as far as capacity expansion is concerned. So yes, several factors that we put the spotlight on, and we also have the management who is now joining us to discuss some of these parameters and what the outlook is for the company going forward. Mr. Sanjay Kumar, CMD at RailTel. Sir, thank you so much for taking your time out and joining us here on ET Now. And first up, let's talk about the guidance that you have shared. 20%, that's the revenue growth guidance that you have shared for FY27. I understand it could be achievable for FY27, but what's the outlook over the next 3 to 5 years? Is that trend sustainable over the next 3 to 5 years?
Yes, I would say that 20% and around plus minus delta, it should be sustainable at least next 2 to 3 years. But I can see the kind of digital initiatives being taken up, and then now those digital initiatives are percolating into tier 2 and tier 3 towns also, not only from government initiatives, but even public related services also now making their heads into the tier 2 tier 3 towns, as far as even data centers are also concerned. So data centers will now go to the tier 2 tier 3 towns also.
Okay, so you're saying that data centers will lead this kind of growth going forward, and 20% is what you've guided for over the next few years. I believe you've lined up about 200 crores of capex for FY27. Will most of it be for data center business?
So I would say that the capital expenditure which we have planned for next financial year is around 300 crore. So this will be a mix of telecom expansion, some replacement of old OFC assets also. And yes, majority of it will go to the data centers.
Okay, so out of the total revenue that you reported for FY26, about 200 crores came in from the data center business. What is the revenue roadmap looking like? I understand that you've already done a lot of investment. You're looking to do a lot of investment going forward. So where will that figure be over the next 3 years? And what kind of revenue share are you aiming as a result of the total revenue pie from this data center business?
So data center, we expect that next year, means present financial year, and maybe one or two more years, we should be touching by next maybe 3 years, 400 to 500 crores. This year, we are targeting somewhere around 300 crore from data center alone.
And how much revenue are you targeting from other businesses, whether it is cyber security or Aadhaar authentication? Those are also two main growth drivers for the company. Will they contribute significantly too for the company going forward?
They will be contributors, of course, though not if you talk from the perspective of overall revenue of, say, in 4,000, 5,000 crores. Certainly, the contribution may not be significant, but since they are good margin business, their contribution to the PAT also will be better, and they are increasing because, like, examinations now, all the examinations are using biometric authentication for the identification purpose. I have recently conducted an exam, very huge exam, 2 exams, where 5 to 10 lakhs of candidates appeared in exams at more than around 1,000 centers. We conducted their biometric authentication online for UP Police. It was a great success. So such kind of opportunities certainly rising, and such similar activities will happen in like JEE, NEET. All these are using our authentication facilities. Maybe UPSC also start sometime. They were talking about it. So this is a business where this is a kind of I would say service which will be utilized not only in exams, maybe in other kind of activities also. So certainly their size will grow in particular, but that will not be so significant, maybe 50 to 100 crores.
Okay, so both these will continue to contribute to the company's top lines going forward, but also wanted your further clarity and further thoughts on edge data centers. You've already, I think, set up about 2 data centers, edge data centers in FY26, and looking to install about 200 of them going forward. What will the timeline be? What will the strategy be? And how will the capex for this be funded?
Okay. So we have now plans to roll out 3 more, maybe in the coming year and a half. One at Indore, then Chandigarh and Visakhapatnam. So these 3 towns we are going with as data centers. We are continuously searching for opportunities in other tier 2, tier 3 towns also. So timelines, I won't say that it is going to happen soon, but yes, once it kicks the demand, I think we may have to roll out faster as far as investment is concerned. So we have an investor partner who is investing into the passive infrastructure as well as active infrastructure, and the management part will be taken care of by us. It is, I think we have discussed earlier also with the ET now. We have Techno Digital. We have with us Techno Digital is our data center company who are already making Noida data center also for us, and it is capex is completely done by them. We are managing, we are controlling. So data plane, control plane is all managed by our in-house team.
Right. As far as telecom segment is concerned, that segment reported solid growth of about 25% in the fourth quarter, and one of the reasons was revenue that you generated from VSS segment. If you can take us through what is the tenure of this particular project that started contributing to your top line in FY26, and how sustainable is this revenue contribution?
I think I forgot to correct one number. You told 200 as data centers. That was not the number. So we have partnered for around 100 as data centers. That is a correction related to previous question. So now we come to telecom. VSS is not a telecom revenue first. This is a project which we are doing for railways for providing CCTV surveillance at railway stations. Yes, as a part of the project, there is an element of telecom where we are connecting these Thana locations to the central locations like zonal railways and divisional railway headquarters. So telecom revenue, of course, will come as a part of it. If we talk of telecom growth during Q4, so it is slightly, I will say there is an aberration, because sometimes in this year, last financial year, some of the circuits were though commissioned in previous quarters but not accepted by the customers, but then they were accepted. So we build all those services from those previous quarters, Q2, Q3 types of quarters, when they were actually handed over to the customer for use. That was the one reason. And then there was a couple of orders also got implemented during Q4, though that revenue also contributed. Like we also increased our dark fiber leasing capacity. We also increased, we had made some good numbers in, I would say, rail wire also, that also contributed. Last year, I think we were somewhere around 5.65 lakhs subscribers. This year, it is around 6.15 lakh subscribers. So this is all around strategy RailTel has taken to increase the telecom revenue as a challenge, and we are strategizing and taking initiatives so the telecom revenue also picks up, because it is a high margin revenue, and that is why our focus is continuously there on this segment, though there is tough competition and there is always continuous pricing pressures in this sector.
And what about signaling projects? Are they expected to pick up pace, especially if you can share some guidance on implementation on 4G and 5G networks?
Those orders are not there with us. We are not aware of any opportunity available right now in the railways regarding 4G and 5G.
All right. And what about Kavach contracts? Have you seen any revenue potential on that front?
Yes. So this year, Kavach contracts will start, I think, contributing towards the revenue. These are also very long gestation projects, 30 to 35 months projects. So one project which is basically two orders which are in East Central Railway, mostly in Bihar. I think those orders will be, now we have spent almost a year in that, and the sites and the outdoor work is now, because there's a lot of surveys, drawing approvals, and all those things are required. I think those works are now under completion. So they will start contributing to revenues, and some of the supplies will also happen. So Kavach will contribute this year, yes.
And can you quantify that for us? How much revenue do you aim to generate specifically from Kavach, and any major order wins that could probably flow in for the company?
So we have 3 orders currently for Kavach. One is from West Central Railway and 2 from ECR, East Central Railway. Currently, we have not seen any new tenders. Of course, if tenders are coming, but right now for last 4 months, 5 months, we have not seen any new tenders. I think Ministry of Railway is thinking that at least these present Kavach orders which are already awarded are first completed, and then they will decide whatever be the reasons. But we have not seen these present Kavach orders which we have already with us. Some revenue certainly will come, maybe around 200 to 300 crores of revenue should come from these orders this year.
Right, so that's as far as revenue from Kavach contracts is concerned, and probably we will see that picture get clearer over the course of this year. But also wanted your thoughts, Mr. Kumar, on margins, because from about 24% that we saw in FY22, margins have contracted to below 15%. I'm talking about EBITDA margins here. What has led to this kind of contraction in margins?
So I think you have very well presented the entire story of RailTel. I must really thank you for this comprehensive historical, right, taking from the legacy picture and now presenting the current thing. So initially we were, I think somewhere around 2013-14, we were a pure telecom company, and the margins were even higher than 24%. We were somewhere around 28 to 30% EBIT margin that time. But then 2019-20, actually we started feeling pressure on telecom business because there was a lot of heat in this market somewhere around 2010 to 2015. You must have seen that so many telecom operators were given licenses and those vanished. So there was a lot of heat, and companies were making losses. So then 2015, we made a data center. We entered into broadband business of RailWire, which is our home service, retail service. Then 2018-19, we diversified into IT and ICT projects. Fortunately, this present government, they had been making all efforts to make this country digital and creating public digital infrastructure. And with these many digitization projects, RailTel had opportunity. It had been wrong if we had not entered in this segment as a system integrator, as a data center service provider. And our senior management then in chair, they decided very rightly to enter into this segment. So this project segment, which is mainly catering to IT and ICT sector with a reference to digitalization objectives, we started 2018-19, and projects, if you see industry-wise, irrespective of industry, margins are generally 2 to 3% to 5% to 7%. That is all. Project margins, because there you are working as a system integrator. You are not supplier. So there, and then we are a government company. We cannot scale immediately whenever some project is awarded to us. So we have to depend on dependable business associates. We have to share our revenues with them also. So that is why our margins, due to project business, certainly were in 5 to 10% range, and our telecom margin was in 25-30%. As and when this project business segment increased, basically the contribution from this segment increased, the pressure on margins, overall margins, it started increasing. And now we are 65% of income coming from project business and 35% of income coming from telecom business for the last financial year. And it will continue to be under pressure. But then again, we are selecting projects with good margins. Somewhere we select projects with lower margins also if the turnaround time of the project is less. If we get the money quickly, there are projects like that. There we go even below 5%. But generally we are maintaining 5% to to 7% of the margin, and then finally we get somewhere around 4 to 5% from project and telecom. So both the margins put together, yes, pressure will be there, but I wish at least this year we will be
Right.
around 15% only.
Right. So the business model has changed slightly, and you've changed your focus and diversified further. And perhaps that is the reason that has weighed heavy on margins over the last few years. But also wanted some perspective on your cash utilization strategy. I understand you have capex lined up, but the cash in books, cash in bank equivalents now stands at about 650 odd crores. How do you aim to utilize this?
So one is capex and opex, of course, nothing more than that. We are hardly using this money for any project implementation. So cash flow issues related to project business is not there, because we have business partners with whom they are contributing to the finance cost to themselves. So that helps us.
Right, so that's as far as the outlook is concerned. Mr. Kumar, thank you so much for taking your time out and joining us here on ET Now. It was quite an interesting and a comprehensive coverage on RailTel. Thank you so much for joining us today.
Thank you.
And with that, it's a wrap on this edition of the show. Thanks so much for tuning in. More on news and updates will continue on the other side.